Corporate governance is a foundational pillar of ESG analysis because it determines how companies are directed, controlled, and held accountable. Effective governance promotes transparency, ethical conduct, sound decision-making, and long-term value creation while protecting shareholder interests. Investors increasingly view governance quality as a key indicator of organizational resilience and sustainability because governance influences strategic oversight, risk management, capital allocation, and stakeholder relationships. Strong governance frameworks help align management actions with shareholder objectives and reduce agency conflicts. However, governance practices are not always implemented effectively due to structural weaknesses, conflicts of interest, cultural barriers, regulatory limitations, or insufficient oversight. Understanding these challenges is essential for evaluating governance effectiveness and investment risk. A critical characteristic of effective governance is a well-designed board structure. Boards are responsible for overseeing management, establishing strategy, monitoring risk, and protecting shareholder interests. Effective boards typically possess appropriate size, expertise, independence, and accountability mechanisms. Board diversity further strengthens governance by bringing varied perspectives, experiences, skills, and backgrounds to decision-making processes. Diverse boards may improve innovation, risk assessment, and stakeholder understanding. However, boards may fail to achieve optimal effectiveness when appointments prioritize personal relationships, concentrated ownership interests, or traditional practices rather than qualifications and diversity. Insufficient diversity can limit perspectives, reduce board effectiveness, and weaken organizational adaptability in changing business environments. Board effectiveness and independence are essential elements of strong governance. Effective boards challenge management constructively, provide objective oversight, and make decisions that support long-term corporate success. Independence is particularly important because directors must be able to evaluate management actions without undue influence or conflicts of interest. Independent directors can improve accountability, enhance transparency, and strengthen stakeholder confidence. Nevertheless, independence may be compromised when directors have close relationships with executives, controlling shareholders, or significant business partners. Boards may also struggle with insufficient expertise, excessive workloads, limited access to information, or ineffective evaluation processes. These weaknesses can reduce oversight quality and increase governance-related risks. Another key governance area involves executive remuneration, performance metrics, and key performance indicators, KPIs. Compensation structures should align executive incentives with long-term shareholder value creation and sustainable business performance. Effective remuneration frameworks often balance fixed compensation with performance-based incentives linked to strategic, financial, and ESG objectives. Appropriate KPIs help ensure accountability and support objective performance evaluation. However, governance failures may arise when compensation packages encourage excessive risk-taking, prioritize short-term financial results, or lack transparency. Poorly designed incentive systems can create misaligned interests between management and shareholders, leading to decisions that undermine long-term corporate performance and stakeholder value. Reporting and transparency are fundamental characteristics of effective governance because investors rely on accurate, timely, and comprehensive information to assess company performance and risks. High-quality reporting improves market efficiency, strengthens accountability, and enhances investor confidence. Transparency extends beyond financial disclosures to include governance structures, executive compensation, sustainability performance, risk management practices, and material ESG factors. Companies may fail to achieve adequate transparency due to weak disclosure standards, limited reporting capabilities, competitive concerns, or deliberate efforts to obscure unfavorable information. Insufficient transparency increases information asymmetry, weakens stakeholder trust, and can impair investment decision-making and market discipline. Strong governance also requires financial integrity and disciplined capital allocation. Financial integrity encompasses accurate accounting practices, effective internal controls, robust audit functions, and compliance with legal and regulatory requirements. Capital allocation decisions should support sustainable value creation through prudent investments, efficient resource utilization, and appropriate risk management. Governance weaknesses may emerge when financial reporting lacks reliability, internal controls are ineffective, or management pursues investments that benefit insiders rather than shareholders. Poor capital allocation can destroy shareholder value and increase financial risk. Investors therefore closely evaluate financial governance practices when assessing organizational quality and long-term investment attractiveness. Finally, business ethics represent a cornerstone of effective corporate governance. Ethical organizations establish cultures that promote integrity, accountability, fairness, compliance, and responsible decision-making. Ethical conduct supports stakeholder trust, strengthens reputation, and reduces legal and regulatory risks. Strong governance frameworks typically include codes of conduct, whistleblower protections, compliance programs, and ethical leadership practices. However, ethical standards may not be upheld due to cultural weaknesses, incentive misalignment, inadequate oversight, excessive performance pressures, or ineffective enforcement mechanisms. Ethical failures can result in significant financial, operational, and reputational damage. Consequently, investors increasingly view ethical culture as a critical indicator of governance quality, risk management effectiveness, and sustainable long-term value creation.